to our lecture. Today's lecture will be part 2 of the material costing, and we will be discussing inventory valuation. So we're dealing with part 2 of material costing, and we're looking at inventory valuation or material pricing. Remember that we have discussed the different parts and documents used in material costing, and today we want to look at how materials are charged or priced to production. When materials or inventories are received into stores from different suppliers and at different prices, it is important that it is valued in a consistent way so that closing inventory values and issues from stores can be valued accurately. This implies that when the materials are issued out, they should be priced. The problem usually is the price to use. This is because materials in stock may have been purchased at varying prices from time to time. There are several methods that could be used to price issues. The objectives of inventory valuation. There are two main objectives of material pricing. 1. To charge to production on a consistent and realistic basis on the materials used. That is, to be able to charge from store how much or what the cost of materials used in production is, and to provide a satisfactory basis of valuing closing inventory. However, the problems of inventory valuations will be the rapid changing prices of materials. 2. The stock of inventories is usually made of different items which are bought at different prices. Like when we talk about materials, we have companies that sell, let's say, cement, rice. They can have cap rice, lake rice, this rice, that rice, those rice. So these are the same commodity, but they have different names coming in at different prices. So if a company is using a cap rice and they had to produce the maybe a restaurant would have to use the rice, it's coming in at different price. So it will be a little bit difficult to value the price of the items. Now, another one is the sensitivity of the profit to the pricing method that is adopted, especially in situations where material cost forms a larger part of the total cost of the company. So in such case, the profit of the company would definitely be affected by the pricing method adopted by the company. Now, the methods of material valuation or inventory pricing. The standard requires inventories to be valued at the lower of cost and net realizable value. That's according to IAS 2. However, various methods are used to value inventories from store to production. This is for reporting, but this is for accounting, or this is for storing. Some of which are the first in first out method, last in first out method, simple average pricing method, weighted average pricing method, standard price method, replacement price, specific identification, retail method, and base stock. These are some of the methods used in valuing inventory, but usually under exam purpose, 1, 2, and 3 are the most preferred and common methods that are usually examined under exam condition. But we will try and look at different methods as much as we can take in this lecture. Now the first method, first in first out method. This is the method of valuing inventory in which issues are made at the price of the oldest batch in stock until all units of the batch have been what? That should be exhausted. Have been exhausted. FIFO assumes that's first in first out method assumes that materials are issued out of store in the order in which they were delivered into inventory. Features: it is an acceptable method for tax purposes. In periods of rising price, product costs are understated and profit overstated. Unrealized profit or losses are eliminated. Advantages of merit: it reflects the normal movement of materials in store, issuing materials in order of receipt. Stock is valued using recent prices. The method is simple and easily understood. It uses actual prices. The disadvantages: the comparison of the cost of one job with another is difficult because different issue price are often used. The cost of a job depends on when materials are requisitioned from stored. The issue price may not reflect the current economic value. Stocks with low turnover will tend to be priced at hold prices when they are eventually issued, and these prices could well be unrealistic. In times of inflation, product costs may be low while replacement costs will be high, thus profit may be overstated. Another method that we have is the last in first out method. Under this method, issues are charged out at the price of the most recent batch that are received and continue to be charged thus until a new batch is received. The last in first out method assumes that materials are issued out of inventory in the reverse order at which they were delivered into store. So that means the last item to come into the store will be the first item to go out of the store. It is an actual cost system. Features: it is disaccredited or rejected by the standard for tax purpose. In periods of rising prices, product costs are overstated and profit are understated. The advantages are that the issue price is near to current economic value. Unlike first in first out, it is fairly simple to operate. It uses actual price. During a period of rising prices, stock values are conservative. Disadvantages: it is not realistic as it is contrary to normal issue procedures that you issue the last item that comes in. So because we are supposed to issue as the items are coming in based on the timing. The frequency of calculations causes much clerical work. Stock values may be significantly understated. Then it can become complicated with fast moving stock, since not all of receipt may be exhausted before a different priced replacement order arrives. So the last in first out, demerit or disadvantages are what we have just discussed. Another method of pricing issues that we have is the weighted average price method, and this method average prices after weighting by their quantities. With each receipt of materials, the weighted average price is recalculated and subsequent issues are priced at the calculated weighted average price. Under a further receipt of goods necessitates the average price to be recalculated. That is, as each items are coming into store, then the quantity of the price of materials are weighted by the quantity of items brought into the store. Our advantage of this method is that it smoothens out fluctuations in the issue prices. The comparison of different jobs is easier because it assumes that values of identical items are all equal. However, the disadvantage is that calculations have to be made to approximately 4 decimal places to achieve a fair degree of accuracy. The issue price may not reflect current economic prices. Then we have another method known as the standard price method. Under this method, a standard or planned price is averaged and predicted for a future period, and all issues will be made at the standard price for the period concerned. So here what this means is that if issues are to be made, it will be made at a standardized price, which is usually fixed by the company. It is easier to operate as there is no variation in the issue price over a long period. Issues will be made at a single price. The efficiency of purchasing is checked as the actual prices are compared with the standard price. Then it eliminates price fluctuations from cost, enabling satisfactory manufacturing cost comparison to be made. These are what we are going to apply soon. Then it requires careful initial determination. The company would have to fix the standard price carefully so that they don't fix a price that will be too high and they don't fix a price that is too low. It disregards price trends. The changes in price fluctuations will be disregarded as a single average price is used. Then we have the replacement price. This method uses current replacement cost or price to value all issues. Issues are at current price. It is easier to operate. Stock values are at the current price because the issues will be made at the current replacement cost. The issue price is not at cost, so where there is a long interval between each receipt of materials, estimates have to be made. Then there is often difficulty and much work involved in ascertaining the current market price. Now this is a specimen of the store ledger account. So it shows the materials, the code for the material, maximum quantity, minimum quantity. So we have the date, the receipt, the issue, and the balance. Now we have the following question to determine the value of issues and closing inventory using FIFO, last in first out, weighted average method, and standard cost of 21 naira. So we are using first in first out, last in first out, and the weighted average method.